Imagine being a single parent with a minimum wage job. The rent is due, your child needs medication, and the fridge is empty. That's when credit, the promise to borrow now and pay later, becomes not just helpful, but essential. But here's the thing. Without understanding how credit works, it can quickly turn from a lifeline into a trap. This presentation is about arming everyone, especially those living paycheck to paycheck, with the knowledge to use credit wisely and not let it use them. Here is the table of contents with the topics that I will discuss. Now let's take a look at what is credit. Credit means you're borrowing money with the promise to pay it back later. It can be used as a lifeline in tough times, but only if it's used wisely. That promise comes with the repayment terms. You're not just paying back the original amount or principal, you're also paying back interest and fees, and those costs can add up fast. That's why every credit arrangement comes with a formal agreement. It lays out exactly how much you'll pay, how often, and what happens if you miss a payment. But before anyone lends you money, they'll do an assessment, which means checking your income, job history, and credit report. For people in poverty, this can be a barrier, but it's also a reason to protect and build your credit history because good credit can open doors when emergencies hit. So credit isn't just a financial tool. For those with limited income, it can be a bridge between crisis and recovery, especially if you understand how to use it well. Now let's talk about the language of credit, because when you understand the words, you can take back control. First, we have principal. That's the amount that you actually borrow. Let's say you take out a $1,000 loan to pay for the rent or cover your bills. That $1,000 is your principal. Then comes interest, and this is where it can get tricky. Interest is the cost of borrowing that $1,000. It's usually a percentage, and if you're not careful, it can turn a small loan into a big burden. That's why low interest loans are especially important for those living on tight budgets. Next, let's take a look at credit parties. There are two sides, the borrower, that's you, and the lender, which is often a bank, credit union, or loan company. The lender gives the money and you agree to pay it back with interest. Before they lend though, they do a risk assessment. They check your credit report, your income, your payment history. They're trying to figure out, can this person pay me back? For someone in poverty, a poor credit score can make borrowing harder or even expensive. But the good news is, improving your credit is possible and powerful. Finally, there's collateral. This is something valuable that you offer to secure the loan, maybe a car or even property. If you can't pay the loan back, the lender can take the collateral. That's a huge risk, especially when every asset counts. So only agree to this if you're confident that you can repay. These aren't just financial terms, they're also tools. And when you understand them, you're not just surviving, you're also building the knowledge to thrive. Now let's break down the different types of credit, because not all credit is created equally. And if you're living paycheck to paycheck, knowing the right kind to use can make all the difference. Let's start with the personal loan. With the personal loan, you get a fixed amount of money and pay it back in set installments, like $200 a month for 12 months. It's predictable and flexible, but you might end up paying more in total interest over time. Then, there's a line of credit. Think of it like a financial safety net. You borrow what you need when you need it, up to a certain limit. It usually has a lower interest rate, but those rates can go up and down. Still, it's way better than a payday loan if used responsibly. There are also overdraft protections, which is when your bank covers a transaction, even if you don't have enough in your bank account. It can save you in a pinch, but be aware. Those fees can stack up fast, especially if you're already stretched thin. Need a car to get to work or school? That's where an auto loan comes in. It's secured by the vehicle, so the rates are usually lower. But here's the catch. The car loses value over time. And if you can't make the payments, you might lose both the car and the money that you already spent. Student loans can also help cover education, which can open doors to better jobs. The good part is you don't usually have to start repaying until after graduation, but there's still a debt you carry, and you need to be aware of the terms and how interest adds up. And finally, there are credit cards. They're convenient and sometimes even offer rewards. But if you don't pay off the balance each month, the interest rates can go sky high. For someone in poverty, this can spiral into long-term debt quickly. So what's the takeaway? Credit can be a lifeline, but only if you choose the type that fits your needs, your income, and your ability to repay. The more you know, the less likely you are to fall into a financial trap. Now let's talk about something that can either save you money or quietly drain your wallet, the APR, or the annual percentage rate. The APR tells you the real cost of borrowing money, not just the interest, but also all the fees lenders can add on. It's like the price tag on a loan. If you're already living on the edge financially, understanding this number can protect you from making a costly mistake. Here's something important. Lenders are legally required to show you the APR before you sign anything. Why? Because it's the fairest way to compare loans. A lower APR usually means you'll pay less over time, and that's crucial when every dollar counts. But the APR isn't one size that fits all. It depends on your loan, your credit score, and how long you'll take to pay it back. Someone with a good credit might get a 5% APR, but someone struggling financially might be offered 25% or more. And that can make a huge difference in how you end up repaying. So next time you're offered a loan or a credit card, don't just ask, "What's my monthly payment?" Ask, "What's the APR?" That one question could save you hundreds, even thousands in the long run. Now let's get into how lenders actually calculate interest, starting with the easiest method to understand, simple interest. Simple interest is exactly what it sounds like. It's simple. It's based on only on the original amount that you borrow, not on any interest that builds up over time. That means your cost doesn't grow unless you borrow more. Here's the formula. Let's break it down. P is the principal, the money that you borrow. R is the annual interest rate, which is written as a decimal. T is the time that you take to repay in years. So overall, the formula is I equals to P times R times T, or simply, the simple interest equals the principal amount multiplied by the annual interest rate and multiplied by the time in years. So let's say you borrow $1,000 at a 5% interest rate and you plan to pay it off in 3 years. You can plug these values into the simple interest formula, and your total interest would be $150, and your full repayment would be $1,150 with no hidden surprises and no hidden charges. For someone living in poverty, this kind of loan is much more safer than the one that charges compound interest, because you always know what exactly what you owe and it won't balloon over time. And here's a pro tip. If you pay off a simple interest loan early, you can actually save money because you cut down the time that interest has to build. Knowledge like this gives you power. The more you understand how interest works, the more control you have over your financial future. Now let's talk about compound interest, a concept that sounds complicated but is very important to understand, especially if you're living on a tight budget. Unlike simple interest, compound interest adds up not just on the money that you borrowed, but also on the interest that's already been added. It's like paying interest on your interest, and over time, that can get expensive. Here's the formula. It is A equals to P times 1 plus R over N to the power of N times T. Let's break it down. P is the amount that you borrow. the principal. R is the annual interest rate in decimal form. N is the how many times interest is added each year. T is the number of years that the loan lasts. And A is the final amount that you owe. Now let's see this in action. Let's say that you borrow $1,000 at 5% interest, which is compounded monthly for 3 years. So the principal amount would be $1,000, the annual interest rate would be 5%, N would be equal to 12, and T is the number of years that the loan lasts, which is 3 in this case. If you plug those numbers into the compound interest formula, you'll get a total repayment of $1,161.47. That's over $11 more than with simple interest. And the difference keeps growing the longer the loan lasts or higher the rate. Here's the thing, compound interest benefits the lender, not the borrower, unless you're saving or investing money. In that case, compounding works in your favor. Here's a smart tip. If you're borrowing, look for loans that use simple interest or compound less frequently, like annually instead of monthly. But if you're saving, try to find savings accounts or investments that compound daily or monthly to grow your money faster. Understanding this one concept, how compound interest works, can protect you from long-term debt and can help you make smarter choices with your money. Now let's talk about payday loans, a quick solution that often turns into a long-term problem. When you're living paycheck to paycheck and an emergency hits, like your car breaks down, or your child gets sick, or the rent is due, a payday loan can seem like a lifesaver. Fast cash, no credit check, money in your hand within hours. But here's the truth. Payday loans come with extremely high interest rates and fees, some equivalent to 300% APR or more. That means if you borrow $500 today, you might owe $750 just a few weeks later. And they're designed to be repaid by your next payday. This sounds simple, but if you're already stretched thin, chances are you won't have the money. So what happens? You take out another loan to cover the first, and just like that, you're caught in a cycle of debt that's hard to break. This cycle is especially dangerous for people in poverty. You're not just borrowing money, you're borrowing stress, anxiety, and financial instability. But here's the good news. There are alternatives. You could try negotiating with creditors or asking for a payment plan. You can look into community-based assistance programs or credit unions, which often offer small, low-interest emergency loans. You can even borrow from a friend or a family member on more manageable terms than a payday lender. The most important thing is to understand the true cost before you sign. What looks like a short-term fix can become a long-term financial trap. Remember to ask questions. Read the fine print. Don't let the urgency force you into something that costs far more than it gives. Because informed decisions don't just save you money, they protect your peace of mind. Now that we know how credit and loans work, let's talk about how to keep the borrowing costs low. Because every saved dollar can make a real difference, especially when money is tight. Here are some simple but powerful tips that can help anyone, and they're especially important for folks that are navigating poverty. First off, you need to limit the borrowing. Only borrow what you absolutely need. It might be tempting to take a little extra just in case, but remember, every extra dollar borrowed comes with added cost. Be focused and be intentional. It's also important to understand the costs. Before you sign anything, take the time to understand the full cost. That means interest rates, fees, penalties, and even late payment charges. A lower monthly payment might not look good now, but it could cost way more in the long run. It's also important to pay on time. Late payments can mean late fees, higher interest, and damage to your credit score. Even if it's just the minimum, Paying on time protects your finances and your future. The next tip is flexible repayment. Check if your loan allows for early repayment without penalties. If it does, that's a great opportunity to get out of debt faster and reduce what you pay in interest. It's also important to pay quickly. The faster that you pay off a loan, the less interest builds up. Even small extra payments each month can add up and save you big in the long run. You can also seek discounts, which is often overlooked. You can ask if there's a discount for paying in cash or setting up automated payments. Some lenders will knock off a little off your rate and every bit counts. Remember, borrowing isn't bad, but smart borrowing is what makes the difference. These habits help protect your wallet and give you more control over your money and your life. Now let's look at the shared responsibility, shared risk. Let's say your friend or family member comes to you and says, "Can you help me get this loan? I just need a cosigner." It sounds simple, you want to help, but before you say yes, it's important to understand what joint borrowing really means, because it comes with a shared responsibility and a shared risk. So what is joint borrowing? Joint borrowing is when two or more people apply for a loan together, often to improve the chances of approval or to qualify for a better rate. In many cases, a cosigner is needed to guarantee the loan. But here's the catch: equal accountability. If one person can't or doesn't pay, whether it's due to a job loss, illness, or another reason, the other person is fully responsible for the entire loan. It doesn't matter who used the money. Before saying yes to joint borrowing, you have to assess your ability to take on the financial burden if things go wrong. Can you afford to cover the payments on your own without pulling your own stability at risk? Also, it's important to understand the risks. If the loan goes unpaid, your credit score could drop, you could face debt collection, and it might even affect your ability to borrow in the future. These are real consequences, especially if you're already living with limited resources. That's why it's critical to know your rights. Review every part of the agreement. Don't be afraid to ask the lender questions. Make sure you fully understand what you're committing to before you sign anything. Remember, helping someone is admirable, but protecting your own financial health is essential, not selfish. Joint borrowing isn't just about trust, it's about preparing for the what ifs. Now let's talk about your rights and responsibilities. When it comes to borrowing money, knowledge is power, and knowing your rights and responsibilities can make the difference between financial confidence and costly mistakes. Let's start with your rights, the protections that you're legally entitled to as a borrower. First off is the clear disclosure. Lenders must tell you upfront the full cost of the loan. That includes the interest rate, any fees, and penalties. Nothing should be hidden in the fine print. Second, we have the prepayment rights. In most cases, you have the right to pay off your loan early without being charged extra. That's a great way to save on interest if you come into a little extra cash. Thirdly, no minimum balance requirement. You're not required to keep a certain balance on a credit card or a line of credit, so don't let lenders trick you into thinking otherwise. We also have a loan agreement. You have the right to a written agreement that outlines all the terms. If a lender refuses to give you one, that's a red flag. Now let's talk about your responsibilities, because borrowing comes with commitments and meeting them helps protect your future. First off, we have repaying on time. This means missing payments can lead to penalties, higher interest, and damaged credit. Even paying the minimum on time helps avoid bigger problems. Second, we have borrowing responsibly. Only borrow what you truly need and know what you can repay. Taking on too much debt can lead to long-term stress and financial harm. It's also important to understand the terms. Before you sign anything, read the fine print, and don't be afraid to ask questions, as this is your money and your future. It's also important to monitor your statements. Yes, keep track of your balances, fees, and due dates. Mistakes often happen, and the sooner that you catch them, the better. It's also important to keep your records. Hold on to all your loan paperwork, receipts, and communications. If a dispute ever comes up, these documents are your protection. At the end of the day, borrowing isn't just about money. It's about trust, responsibility, and long-term stability. When you know your rights and take your responsibilities seriously, you're not just surviving, you're building a stronger and more secure financial future. Now let's talk about the key details before signing a loan agreement. Before you borrow money or before you sign your name on any loan, there are four key details that you must understand. Knowing these details can protect you from hidden costs, surprise charges, and financial stress. First off is the interest rate. This is the percentage you'll pay to borrow money, usually known as the annual rate. But here's the catch. Some loans calculate interest daily, some monthly, and others annually. The more often it's calculated, the more it can cost you. So always ask yourself, how is this interest rate applied? The second key detail is the grace period. Some loans, especially student loans or promotional credit offers, give you a grace period. This is the time where no payments are due and no interest can build up. If you're in a tough spot financially, this grace period can give you breathing room. But not all loans have it, so be sure to check. The third key detail is when the interest starts. Even if you don't have to start paying right away, that doesn't mean that interest isn't being charged. So always ask yourself, when does the interest start accumulating? Some loans can begin charging interest immediately, even during the grace or deferment periods. The fourth key detail to understand are your monthly payments. You need to know exactly how much you'll be expected to pay each month. Is it a fixed amount like $100 per month? Or is it a percentage of your balance which can change over time? Knowing this can help you plan your budget and avoid falling behind. Because when it comes to borrowing money, the fine print matters. And the more you understand now, the more confident and protected you'll be later. Now let's pull everything together with the key takeaways. The habits and mindset that will help you borrow responsibly and protect your financial future. First off, it's important to repay wisely and protect your credit. Missing even one payment can hurt your credit score and rack up fees. So set reminders and pay on time every time. Secondly, it's important to understand your credit options. Credit cards, personal loans, lines of credit, each come with pros, cons, and costs. So don't just accept what's offered. Learn what fits you best. Third, know the full borrowing cost. Look past the monthly repayment. What's the total amount that you'll repay over time? Ask about the fees, the interest, and penalties, as this is the real cost and it might be more than it looks. It's also important to shop around for the best deal. Don't just settle for the first loan offer. Compare the interest rates, the APRs, and the repayment terms from multiple lenders, because even a small difference in rates can help you save a lot of money. It's also important to focus on the APR, not just the rate. The annual percentage rate shows the true cost of borrowing, not just the interest, but also the extra fees. It's the best number to compare between loans. It's also highly important to be a savvy consumer, which means ask questions, read the fine print, and negotiate when possible. And always keep learning, because the more informed you are, the more empowered you become. Credit can be a tool or a trap, but with the right knowledge and habits, you can use it to build a better, more secure future for yourself and your family. Thank you for listening.